For the first time in 10 years, not a single hurricane made landfall on the continental United States. 13 named storms, 5 hurricanes, 3 of them Category 5, the second most on record. And every one of them curved back out to sea before it reached the coast. And still, your home insurance went up 12% in a single year. That's not a temporary spike, it's the new floor. Since 2021, the average home insurance bill in America is up 64%. You've probably heard that home insurance gets more expensive because disasters are getting worse. Hurricanes, nor'easters, storm surge, they cost more, so you pay more. And that's true. But the biggest increase in the country isn't on the coast. It's in Arizona, up 94% since 2021. In the city of Prescott alone, some homeowners have seen their premiums more than double in just a few years. And clear across the country in Iowa, the nation's top corn producer, more than 1,000 miles from the nearest hurricane, home insurance is up 83% over the same period. The places leading the entire country are the ones hurricanes never come near. So what do they all have in common? What do Florida's hurricanes, or a wildfire in California, have to do with a home insurance bill in Iowa? And who pays the bill in the end? To find out, we have to follow the trail of money that moves between the insurers themselves. In August 1992, Hurricane Andrew came ashore south of Miami as a Category 5, 650,000 claims, $15.5 billion in insured losses, at the time, the most expensive disaster in American history. The insurance companies didn't just pay, some of them couldn't. 8 went bankrupt as the claims poured in. 3 more failed within the next year. Families who had paid their premiums for decades were suddenly holding claims against companies that no longer existed. That disaster taught the industry a lesson it never forgot. A single storm can kill an insurance company. So the companies did exactly what their customers do. They bought insurance. Insurance for insurance companies. Ironic, isn't it? But it exists, and it has a name: reinsurance. Reinsurance is centuries old. What Hurricane Andrew created was a gold rush around one kind of it: catastrophe cover. Investors poured billions into new reinsurance companies, many of them on a small Atlantic island with low taxes and fast licensing: Bermuda. Today, a handful of giants in Munich, Zurich, and London stand behind a huge share of the home policies written in America. Every month, part of your premium travels up the chain to those reinsurers as the price of their protection. In exchange, when a catastrophe too big for your insurer hits, they cover part of the loss. Your local insurance company is holding a global safety net. But that net comes with a catch. A reinsurer in Bermuda doesn't just cover Iowa, it covers the world. A typhoon in the Pacific, a flood in Germany, a hurricane in Florida, a fire in California, all flowing into one giant pool. So when losses pile up in any corner of the planet, the price of protection rises in every corner. Between 2018 and 2023, that price roughly doubled, and your insurer doesn't absorb the increase, it passes it down. A tsunami on the other side of the world can end up folded into your bill without you ever noticing. Because through that pool, you've been paying for the planet's disasters all along. But the pool raised its price on everyone, and the pain didn't land on everyone equally. While reinsurance was globalizing the cost of disaster, the companies collecting your premium were doing something new closer to home. They stopped looking at your neighborhood. They started looking at your house. For most of a century, home insurance ran on one simple idea: nobody knows whose house will burn, so everyone pays in. Disaster hits a few. The pool takes care of them. Your rate was set by averages, your town, your zip code. Because every house carried the same weight, a safer home paid a little more than its real risk, and a riskier home paid a little less. Then the company stopped weighing every house the same. Over the last decade, insurers built a portrait of America where every single home has its own file. Satellites, airplanes, drones. One company, Verisk, holds aerial imagery covering 94% of the country and runs it through AI to score your roof, its age, its condition, its fire, and hail risk. The algorithm doesn't see a neighborhood. It sees your roof, one shingle at a time, moss, trees leaning over the house, old shingles, your kid's trampoline in the backyard. Each one a reason to raise your price or to walk away from you. In Auburn, California, Cindy Picos was dropped by her insurer after aerial photos of her roof. The company said the roof had reached the end of its life. An independent inspection found it had at least 10 years left. She asked to see the photos. The company said no. Outside Boston, John D'Entremont got a letter after 40 years with the same insurer, and not a single claim. Fix the moss, trim the tree, replace some shingles. He did the tree work and kept his agent updated. They canceled him anyway. You no longer have to file a claim to lose your insurance. You just have to be seen by a satellite, a plane, a drone, and judged a risk. And once every roof is priced alone, the old arithmetic of sharing fades away. Federal Treasury data shows what replaced it. Homeowners in the riskiest 20% of zip codes now pay 82% more than the safest 20, and lose their policies at nearly twice the rate. On paper, that might even sound fair. Everyone pays their own risk. But if you can't see the photos, you don't even know exactly why you're paying more. And high risk isn't only about fire and floods. One study of millions of policies found your credit score moves your premium as much as your actual disaster risk. Worse credit, up to 24% more for the same coverage. Part of high risk is a physical fact. Part is just a decision about how much to charge you. And every year, the map of who counts as high risk gets bigger. When yours crosses that line, the price doesn't rise to match your risk. It rises past what you can afford, and no one shares it with you anymore. But a house standing alone has a breaking point. The day the company decides no premium is worth the risk. And insurers don't walk away from one house. A wildfire doesn't burn one house. Disasters hit everything around you at once. When a company leaves, it leaves entire zip codes in a single stroke. One state is further down this road than the rest. That state is Florida. Florida has always been an expensive place to insure a home, around $8,300 a year now, the most expensive in America, nearly triple the national average. But the price isn't even the worst part. The worst part is what happens after a storm. When Hurricane Ian tore across the state in 2022, one of Florida's largest home insurers, United Property and Casualty, 160,000 policies, was buried under more than $1 billion in claims. Within months, it was bankrupt, with thousands of those claims still unresolved. 30 years after Hurricane Andrew, the same scene was playing out again. Wasn't reinsurance invented to stop exactly this? It was. But reinsurance softens the blow. It doesn't take it away. And remember, its price had roughly doubled in just a few years. Florida's smaller insurers could only afford less of it. And less protection means the help starts later, with the insurer absorbing more of the damage alone. Since 2021, at least 8 Florida insurers have gone bankrupt. Others left the state entirely. But a hurricane alone doesn't explain the collapse of Florida's insurers. Out of every 100 home insurance claims filed in this country, about 9 came from Florida. But out of every 100 lawsuits filed against home insurers, nearly 80 were Florida cases. The insurers blamed fraud. Homeowners blamed checks too small to fix the roof. And while that fight dragged on, more companies failed or walked away. And the problem is, if you have a mortgage, insurance isn't optional. Your lender requires an active policy. So your insurer is gone, no private company wants your house, and the bank still demands coverage. Where do you go? In Florida, there's one door left. Citizens, the insurer the state created as a last resort. By 2023, the backup plan was the largest home insurer in the state. Not because anyone chose it first, but because for hundreds of thousands of families, it was the only option left. And that door has a cost hidden inside it. When a year with a big enough disaster empties citizens' reserves, the law spells out who refills them, its own policyholders first, through a surcharge of up to 15% on top of their premium. If your policy costs $8,300 a year, the state average, that's a bill for up to $1,200 more in the middle of a disaster. And if that isn't enough, another 10% a year on nearly every policy in the state for years. So the risk simply changed hands, from the private insurers to the state and back down onto the people paying the premiums. In Florida, that bill already has a name, the hurricane tax. Same problem, except now you pay even more for it. Florida rewrote its legal rules in 2022 and 2023. Lawsuits dropped. A few insurers are trickling back, The price never went back to what it was, but Florida is a state famous for hurricanes and big visible natural disasters. The states where insurance climbed fastest over the last 5 years aren't hurricane states at all. Arizona, Iowa. The disasters draining those places rarely make the evening news, and they're the ones your insurer fears most now. The industry has a name for them: secondary perils, hail, windstorms, flash floods, wildfires. Secondary, as in smaller. Background noise. That label is out of date. In 2025, thunderstorms, just thunderstorms, cost American insurers $51 billion, the third year in a row above $50 billion, more than any other kind of natural disaster in the country. A hurricane is one enormous bill every few years in one place. Hail is a smaller bill, everywhere, every year, without fail. A single hailstorm can sweep across an entire metro area, damaging every roof in its path. And roofs are the expensive part. Hail drives up to 80% of severe storm claims. Now look at Iowa. Since 1980, Iowa has been hit by 86 separate billion-dollar disasters. 57 of them were severe storms. And in August 2020, Iowa took one of the worst storms in its history, a derecho with winds over 100 miles an hour and damage across a third of the state's counties. The bill came to around $11 billion, a hurricane-sized loss in a state 1,000 miles from the ocean. Most of the country never heard about it. It didn't get a name, it got a weather term. And Arizona? Arizona's #1 disaster is wildfire. In the hills around Prescott, premiums have doubled and carriers are declining renewals. Vivian Winicky lives in Dewey Humboldt, just down the road, retired, fixed income. She volunteers as a wildfire mitigation assessor, helping neighbors clear brush and harden homes against fire. Then her renewal letter came, $4,500. The year before, she had paid $1,450, tripled from one renewal to the next, an extra $3,000 a year. Storm after storm, payout after payout. Companies failing in Florida, pulling out of Iowa, retreating from Arizona. By now, you'd expect the insurance industry itself to be on its knees. It isn't, and that's exactly the point. 2025 was one of the most profitable years the American insurance industry has ever had. In 2025, America's insurance companies collected close to $1 trillion in premiums and turned a profit of about $63 billion on those policies, nearly triple the year before, their best result in more than a decade. Their reserves, the cushion built to survive catastrophes, hit $1.2 trillion, the highest ever recorded, bigger than the GDP of many countries. And the factors behind a year like that are the same ones we've been following this entire video. Price: 5 straight years of rising premiums. Selection: the satellites and AI models reading your roof. Never customer service, a sorting system built to find the homes most likely to cost money and move them off the books before they do. Transfer: and the riskiest homes of all didn't stay with the insurers at all. They went to state-backed plans like Citizens, where the risk becomes everyone's problem. Even the reinsurance pool cooperated. After years of steep increases, its price finally eased through 2025 and 2026. Your premium didn't follow it down. Record profit on one side, record premiums, and canceled families on the other. Both real, both made by the same machine. Who pays the bill in the end? In January 2025, one of the people paying it lived in a Los Angeles neighborhood called Pacific Palisades. Francis Bichetti spent almost his entire life in the same house in Pacific Palisades, Los Angeles. 55 years old, a personal assistant. In 2024, farmers quoted him a new price for the same house, $18,000 a year. He had been paying $4,500. He couldn't pay it. He tried the California Fair Plan, California's insurer of last resort, the same idea as Florida's Citizens. To qualify, he needed to cut down 10 trees around his roofline. He couldn't afford that either, so he went bare. No insurance at all. He watered his yard year-round and hoped that would be enough. On January 7, 2025, the Palisades fire reached his house. Francis tried to save it. He couldn't. The home he had lived in almost his whole life burned to the ground, along with everything in it. No policy, no claim, no check. He lives with relatives now, applying for FEMA aid. And many Americans are making the same choice. In the hills around Prescott, Arizona, homeowners who've paid off the mortgage are dropping insurance entirely. The premium stopped making sense. The ones who can't walk away end up in the FAIR plans, the last resort insurers, the Citizens model, state by state. When the January fires hit California's plan, the losses ran into the billions. And by law, part of that bill can be spread across every insured homeowner in the state. And if you think this hasn't reached you, look at your mortgage statement. Your insurance is folded into the monthly payment through escrow. Your interest rate is locked. Your payment isn't. And if you want to understand why buying a home became nearly impossible in the first place, why prices never came back down after 2008, why a whole generation got locked out, we told that half of the story in our first video. It's on your screen now. Subscribe to see more.